Thank you for joining us for Iress's inaugural Future Mortgage Efficiency broadcast, brought to you in partnership with the Building Society Association. Today, we're fortunate enough to have some of the Building Society community's brightest and most innovative minds who will share with us some of the reflections, thoughts and expectations they have for the coming year over the next 15-20 minutes. By way of introduction, I would like to welcome Tracy Simpson, Head of Lending at the Cambridge Building Society, Darren Ditchburn, Chief Customer Officer at the Darlington Building Society, Carolyn Thornley-Yates, Head of Mortgage Proposition and Distribution at the Hinckley Rugby Building Society, Rob Thickett, Digital Policy Manager at the BSA, and Steve Carruthers, Principal Mortgage Consultant at Iress. Welcome to you all. I'd like to start, if I may, with your reflections on 2020 and some thoughts on some of the views you expressed in the Mortgage Efficiency Survey. Tracy, looking back at the year, did it pan out the way you thought it would back in the dim distant past of April?
Well, I think when we met, we were about 5 weeks into the pandemic, and we were just settling into new work patterns, working remotely. At the time, activity was slowing a bit. There were lots of mortgage products that had been withdrawn. Physical valuations were on hold. And so we were sort of planning for the worst in some respects. However, looking back now, activity picked up a few months after we had our conversation. And actually, we've achieved much greater levels of business than we were forecasting at the time. There's a lot of activity out there, and we've had to probably subdue that activity by sort of changing our distribution model as we were working along this year.
And what's that, can I just pick up on that? What's that change in distribution sort of meant for you, really, in real terms?
So we've just been very mindful, because we're very keen on delivering the service levels that our intermediaries and our customers expect. We didn't want to be overwhelmed with business that we couldn't actually process. Yeah. So we're having to take a very sort of tactical approach, and decisions we make, along the way. We're looking at what others are doing, looking at the impact of that to our teams. And so that's how we've been working this year.
And isn't it? One thing that the survey did bring out was the need for at least a hybrid approach of manual and automated underwriting. And so we sort of smaller societies with our manual underwriting models already well up and established and running smoothly, we were ideal places to place these unusual cases, and we already had our processes in place. And so yeah, we found very similar that we were suddenly very popular and very well placed to turn this business over. So yeah, agree with what Tracy says there.
I think at the time as well, we were business was slowing, and we've had to sort of move, well, certainly had to move some of my teams around to support our existing customers as well during that period. So not only you're looking at trying to keep the business levels flowing, but you have to manage also our existing members and their needs at the time. So we were very mindful of making sure we were actually delivering the service to everyone that we, the best service that we could to everyone.
Yeah, I think naturally that the businesses moved into crisis mode, didn't they, in kind of the March, April time. And that kind of outlook then has a focus internally on what you needed to do operationally to support your kind of members, local communities, and kind of you do then start forecasting the kind of worst case impact on business scenario, and I think that does kind of cloud the outlook to some extent. But I think the thing that none of us predicted was just how far and profound the changes are in people's circumstances. And I think that goes both in a negative perspective and a positive perspective. So I think we took, naturally within financial services, the lens of the negative side of the impact. But actually, there are some more positive sides of that, and that we've talked about in the past around things like you know, people wanting to move house because they've had a change in circumstances due to their working conditions, or actually their living environment that they've spent a lot of time in. They've had time to reflect on that, and actually they want to move to somewhere with a bit more space, garden, or in the country, as an example. So all of that has kind of increased the level of activity and demand that we're starting to see.
And also the government's interaction, you know, with regard to stamp duty holidays and removal of Help to Buy, you know, all of this, people are on a race to get things completed. So of course it's sort of, it builds that perfect storm in some respects.
And so, I mean, the speed and the pace of the change, I mean, I think I remember saying to someone in March, oh, don't worry, we'll all be back by the end of May. So it shows how much I know. But the speed and pace of that change, as you say, and the scale of the interventions was something quite profound, wasn't it? I mean, it's certainly, I don't think any of us would have thought that a furlough scheme would have been dreamt up as quickly implemented and still with us in March of next year. And did that sort of you know, it certainly took me by surprise. Was that true for all you guys as well?
Yeah, I don't think we, as you say, I think it's unprecedented, isn't it? The level of kind of intervention in the market that the government's had to kind of to put in place to support people. But you know, I think that level of intervention to some extent has given confidence to the market in some respects, because you know, it does give a view for a period of time of some certainty, some element of certainty to those individuals impacted by that decision. So, you know, from my perspective, I think that's a really good thing that they've taken them decisions quickly and tried to give a period of time in front to try and give business and individuals a bit of certainty over the direction. I mean, clearly, as the Chancellor said, you know, on numerous occasions, they can't protect everybody from the economic consequence of the pandemic, but, you know, the level of intervention they've put in place so far has been really good, I think.
And you can see that in terms of the impact on the actual property market as well, in terms of property prices. You know, I think looking at the kind of beginning of the pandemic, everyone would have been expecting things to kind of walk off a cliff. But I think those supporting measures really have been vital. But, you know, all of them combined are kind of difficult challenges for lenders to kind of deal with internally. And, you know, even looking into next year in terms of, you know, whatever happens with the stamp duty holiday and whatever happens with the rollout of vaccine, which, as we're recording this, has been approved. But, you know, in terms of where that goes, it's kind of the next day, there'll all be challenges in terms of for lenders, how they actually deal with that internally and how the market kind of processes it.
Yeah.
I think it's really important how the economy pans out in the next 12 months, really, for us to make decisions. I think absolutely, I think the government did the right thing at the right time, reassuring the market. It's how that plays out, the unintended consequences of things into next year, and how that affects customers, people wanting to move home, etc. That'll be an interesting thing to see, and how lenders like us can support those people, because everyone has gone through, you know, huge difficulties, you know, if they've been put on furlough or if they've taken payment deferrals and what have you, you know, the shape of their credit profile has changed, and it'll be up to us to try to find solutions for these customers going forward, I think, into next year. I just think it's going to be a tough next 12 months.
Yeah, and I suppose to some extent, notwithstanding all of those safeguards and protections, there are some things that the pandemic's possibly accelerated, like the ailing of the high street, which you know, sadly we've had the news of the last couple of days, which there is just very little anybody can do about that while we are, you know, sort of you know, having to behave economically the way we are, I guess, and that will be, I suppose, one of those challenges you're referring to for next year. One of the things I'd like to ask you all is, were there any surprises in the survey that we published? Having spoken to 37 lenders, was the consensus something that you thought, yeah, that's where we fit, or were there some things that raised an eyebrow?
I think from my perspective, Matt, Matt, a topic very close to my heart at the moment is the decision in principle. You know, in these uncertain times, having a reliable and an efficient DIP process has been absolutely vital in the market, and that's even harder for manual lenders who are operating manual DIP processes. And I think the big surprise for me in the survey was the wide margin between lenders' DIP accept ratios. So for all lenders, the ratio was as low as a 35% acceptance rate to 96% acceptance rate. And for Hinckley and Rugby's peer group, it was 35 to 80%. And I'm thinking, well, that's a massive gap, you know, and 35% DIP accept ratio, you know, that really does make me wonder why it's so low. You know, are lenders publishing their criteria clearly? Are brokers able to read and interpret that criteria? Were the changes moving so fast that people just didn't know where they were? Or was it indicative of brokers trying out new lenders as their former go-to lenders weren't able to service them anymore? And so one good thing I'm hoping for is a wider use of different lenders now that familiarity with their cultures and systems has possibly been achieved.
Yeah,
I just wondered as well from looking at those graphs last night, Carolyn, and somebody mentioned about, you know, in terms of DIP efficiency, whether there will always be kind of a lag between, you know, because in terms of for brokers at the moment, you would go to kind of maybe the top 6 or 7 or 8 lenders initially, and then you would then the second dip maybe towards the kind of building society market, and then maybe where they would have to kind of then refer, because you're dealing with that grey, which I think was one of the comments in the mayor's report, wasn't it, in terms of, you know, our market is a grey. I just wondered whether you thought that could ever be overcome in terms of technology, because there seems to be things coming down the track in terms of kind of piping up lenders and brokers and even consumers direct, where, you know, potentially they could do. But I just wondered whether that was sort of something that was structured into the market that could not be overcome in terms of, you know, the way building society position their products.
Just coming on that point then, Matt, that Rob's made there, that I remember when we did the survey, one of the comments that came over fairly frequently was the fact that lenders find it a challenge to keep product sourcing systems and criteria sourcing systems up to date with all the changes. So as you say, Rob, and the lenders here, it'll all resonate. You were having to change products and criteria in some instances almost on it felt like it was a daily basis. And you know, on a positive note, we've seen the emergence over the last couple of years of the criteria-based sourcing systems, and there are a good 2 or 3 that exist in the marketplace. So they sit alongside the more traditional product sourcing systems that have been around for years. And I think what we're starting to see now, though, is an emergence of integration with the sourcing systems, which hopefully the lenders will welcome, because we can ask the lenders, but it must be difficult trying to keep all the systems up to date.
Yeah, it is. It's very...
I absolutely agree with you on that. And also, from an intermediary's perspective, you know, they don't want to source in many areas, you know, and with customers' situations changing so rapidly, you know, it's a really, really difficult process. And I was like Carolyn, you know, I was surprised at the scoring. It was the lowest score, because actually my nature says, you know, it's first impressions. So you always makes the best first impressions, and it's the back end that actually scurry around and try to get sorted. So for me, I was sort of slightly comforted, because it's always, you know, for a smaller lender, exactly what Carolyn was saying, you know, it's difficult to put all of our criteria and all our nuances on these criteria searches and things. So, you know, there's usually a story. So yes, I was. And I was also surprised at, you know, hard footprints also featuring still.
Yeah, that was
at stage, which you know, again, was another surprise. So yeah, there
were I too very surprised as a former lender as well, the number of lenders that are still using hard footprints at the dip stage. Very surprising.
I think the other thing from our perspective is even with those ratios being quite surprising, you know, we've seen an increase in the amount of dip declines since taking the survey. So we've probably seen our dip declines go up between 10 and 15%. based
Right.
on kind of normal standard averages. And that really is due to a combination of factors. One being, as you say, we have a lot of new intermediary partners using the society for the first time, and therefore trying to get used to what is our kind of standard criteria, which is moving on, daily, weekly basis when we're trying to keep reacting to market conditions. And then, naturally, lenders are being more diligent around kind of their underwriting that they're applying to standards. I mean, ultimately, one of the biggest challenges we all face at the minute is understanding the future sustainability of income. That's very difficult to do in these uncertain conditions, which gives you that increased kind of variability in terms of what you can say yes to and what is now a no, which actually 6 to 9 months ago could have been a yes.
Yeah, Darren, you've absolutely beautifully segued into my next question, which I'm very grateful for, because it was what the alteration and the to job support schemes and the impact they've had. Do you feel that is going to be the big issue for lenders over the next 12 months, or are there other things that you're thinking about which actually might come to the fore?
Yeah, well, I think that on that point, the future sustainability of income, lenders like track records and being able to see kind of the income over a sustained period of time. You're going to have now a lot of people with a lot of changing circumstances, where potentially people with self-employed businesses that have been there, for a long time, trading very well, great performance, but, for circumstances completely beyond their control, they're going to have some large holes in those accounts next year. And they're going to need, they're going to need people to be able to look beyond the numbers and actually start understanding the future trading position of the business to make lending decisions. So, and that's just one example, but that future sustainability of income, when you've got COVID and you've got potentially the impact of a no-deal Brexit coming down the line on employment, it's such a challenge at the minute from that perspective.
And there's still very much talk about house prices and what the effects of unemployment, the economy, etc. on those in the next 12 to 18 months. So I think there will be very cautious activity from lenders with regard to sort of trying to sort of lend responsibly, I guess, and having that sort of future look at the applicants in front of us.
Yeah, I think that's why I think it's really important, the point on unwinding the stamp duty. And, we've got that kind of cliff edge risk at the minute that, stamp duty comes to an end on the 31st of March. And then what happens? Do we see a lot of people who've kind of missed the deadline because of capacity issues pull out and start seeing kind of transactions in the chain start to fall down? Or, I think, from a government perspective, we need to see some sort of tapering so that we don't see a kind of lasting impact on house prices, or a real kind of adverse effect on house prices as a result. Because I think that's what the market needs, is some consistency around things like house prices to give confidence, and that confidence will bring back kind of that normalization of kind of lending criteria, and with a more sustainable view of the future.
I noticed actually in one of the papers, I think it was yesterday or the day before, ran an article that that point isn't lost, that a cliff edge end to stamp duty will actually, it not only in terms of missing it, but will affect affordability for people as well, which will again collapse chance. So I don't, and the article was implying that wasn't lost on our Lords and Masters in Westminster. So it's crossed, I guess. Has the focus on operational performance diminished? Do you think, because it seems to me, I mean, please correct me if I'm wrong, but it seems to me that this year was very much about coping operationally with what was there and the moving parts. Has that sort of diminished the focus for you on sort of market share activity, and sort of what's the impact of that, or if there is any, on your sort of API strategy for the coming year, couple of years?
I think for us, sustainable growth has always been the key objective for the business, and therefore kind of finding the right balance between operation and kind of volume has always been a key goal. I think for us in the future, we look at kind of that bit around being able to provide a better service operationally to stay competitive. And I think what this kind of pandemic has shown us is that not only do you need it to remain competitive against your peers, etc., it's becoming an essential because of the way of those profound changes in business and the way that things are done. So I think, for us, that sustainable growth strategic goal has always been there and just emphasises the importance of it from our perspective.
From our perspective, obviously there are some advantages that we'll take from the last few months, and those are the efficiencies of working from home, knowing that your staff can work from home and they can work from home very efficiently as well. And sickness absence has dropped dramatically for us as a result, which has been really interesting. We're using AVMs now, which we weren't using before, and we intend to do that permanently. But I think it's, in terms of priorities, we've maintained a priority on the digital strategy that we're currently preparing for, but also launching new products. We've not wanted to move away from that. And so we've very much kept the momentum on that. And as Darren says, it is about remaining competitive and relevant and adapting to circumstances. So no, I think it would be a false time economy to deprioritise any of those things because of the operational challenges that we've experienced.
Yeah, okay.
One area that, in terms of operational performance, that came out in the survey discussions Matt and I had with lenders this year, more this time than ever, was open banking. And in the subsequent conversations I'm having with lenders, with the follow-up calls I'm having with all the lenders that took part in the survey to go through individually, there's again more conversations about open banking, more forums I've been on recently, and Rob, the BSA recent events, the Digital Mutual, open banking featured again. So I'm starting to get a sense that lenders are looking at open banking potentially more seriously now than previously. I mean, it's been, open banking has been around for a number of years, and it's been used or piloted to some form or extent by numerous parties in the industry. But do you think over the next 12, 24 months, you can see there being benefits of open banking for lenders?
Yeah, I personally think, Steve, it's wider than just open banking. It's connectivity, and that whole end-to-end experience, right from the beginning of the broker sitting down with the customer, taking it right through to completion. It's that connectivity and connecting the different pieces of the jigsaw right through the process, which for me is another key part. Open banking is one element that will facilitate some of that, and I do think that, I personally think, there's still a lot of work to be done for lenders in connectivity with third-party suppliers through the supply chain, as well as kind of then looking and considering the open banking bit. There's almost a foundation level that needs to be completed before you get to the next level, if you like. And certainly that's our strategy. We're working, as you know, with Iress and the MSO to be able to start that work on integrating with things like the payments, valuations, conveyancing, all that stuff is great. And then the next level for us is that kind of open banking bit, but we want to be able to walk before we can run.
Yeah, makes sense.
And I think it's really important to do it in a managed way, and making sure that you've got the right integration at the right time. Because I mean, what we're looking at is what our customers and our intermediaries want as well. We sometimes you go to these sort of seminars and things, and you can be blinded by all the wonderful technology out there, but actually you've got to do it in a proportionate way. You've got to think about what your customer and intermediary wants, and you have to plan, you have to plan ahead. So open banking, absolutely, we'd be looking at that, but it might not be the first thing. Going back to what Darren's saying, there may be some other things that we need to consider first before we take that step.
Makes sense.
We have to be careful not to get left behind as well.
Oh, absolutely. I
think that's the difficult balance, is because you're going to have intermediaries who are using this technology, and typically they're quicker to adopt the technology than us, and it brings that kind of misalignment in the process at times between kind of, you know, if they're using open banking to read bank statements and we're not, as an example, that can be difficult challenge when we then have to go back to the broker and say, can you get me 3 months bank statements, as an example.
Yeah. I think something that came out of your report is the legacy systems as well. You know, with regard to some people or some lenders have some real problems, back office problems, and they'll, you know, they might want to connect or, you know, digital processes, but actually they're grappling with this sort of monster behind the scenes as well. So, you know, I think there's a lot to
absolutely
in that journey.
You're right. There was a real divergence of position in terms of where lenders are. Some lenders are much further down the track, and typically any lender that's kind of been a new start or a challenger that's been able to launch without any legacy, as you'd imagine, are much further down the track. And as you say, those lenders with legacy systems are just finding it that little bit harder to connect everything up together. So it's going to, I think I like Darren's analogy. I like the building the foundation to then move forward at a balanced and measured pace, and as you say, Tracy, that meets your customer and your intermediaries' needs as well.
But I think that's what came out from the MES report for me, was around this kind of structural challenges in the market. So not just things around sort of, say, on speed or the affordability, but things like digital ID, like ID and verification. You know, if you could have a kind of framework that all parts of the housing industry, you know, in terms of buying or selling a property, there are so many different parties within that, in terms of estate agent, conveyancer, lender, broker, you know, even from just a kind of buyer's point of view, that's a massive hassle, but actually it's also inefficient for all of those parts of the chain. So if there could be a framework that could really be trusted, and you know, it's not just for kind of for the mortgage and housing market, that applies equally for kind of things like payments generally, and savings and other bits like that, you know, the efficiencies that could be gained from something like that. Not to mention things like also around, you know, Matt mentioned like APIs, but in terms of there are all these different solutions occurring in the market to kind of connect up different bits, but they all have their own API standards. Nothing is really, you know, I think was it Maria Harris, she kind of phrase around spaghetti mixture, and that's kind of how it seems, you know, rather than kind of creating necessarily simplicity or clarity or even efficiency, it could potentially be creating more complication and more cost for lenders and brokers.
Yeah, I mean, I think you know, what somebody once said to me, that one of the biggest challenges that financial services has generally is that it's bringing an industry to technology and becoming a technology business at the same time, and actually getting that culturally through an organisation is actually quite a difficult thing to get into. You know, to have people in the boardroom who once upon a time coded, for instance, you know, at some point will be a thing, but it's possibly not at the moment, and that transition's quite a difficult journey sometimes when you've got the legacy systems and stuff that we've spoken about.
But there's an opportunity to have a partnership though in terms of technology firms, you know, because like Darren, Carolyn and Tracy, you know, you're all customer journey specialists really within the mortgage journey, but the kind of technology people will likewise, they'll bring those expertise. So there is a kind of marriage. Somebody was kind of talking to me about the kind of apps that they developed, and that was kind of how they did it. They provided that kind of customer journey knowledge of the market, but then the IT people can then provide the kind of means to actually, just as Darren's doing with MSO and Iress, to kind of simplify and make a better journey.
I think it's fundamentally some of the cultural change within our business as well there that Matt's talked about. Technology has been seen traditionally in the business as the nuts and bolts of technology. And actually in our business, we now have kind of two aspects to the digital side, which is the technology nuts and bolts, as you say there, Rob, and then the customer and business perspective as well. And it's important to bring those two together to get that kind of future digital strategy right for the customer.
And I suppose when you consider that, then I mean, how important are the various sort of market niches in terms of first-time buyers or other niches that you may think for you guys in the coming year? Because I was talking to someone the other day, and they mentioned that one of the they feel one of the very underserved or difficult markets is the 50-year-old market at the moment, which is actually in and out of is properly gig economy stuff. And to your point about understanding stability of earnings and Darren, then are there segments that you're particularly focused in for 2021, whether that be the first time buyer or later time buyer or whatever, or how important do you think that your attitudes to that will be for product innovation?
I mean, I think obviously first time buyers as building societies, we feel we should absolutely be catering to this market. They're 33% of house purchases, and it's in our DNA to make sure we've got solutions for them. So I do think family assisted mortgages for those first time buyers lucky enough to have relatives who can charge money or property to alleviate the need for a deposit or significantly reduce it is really good. I mean, in addition, we've developed a complex income range, which we find, given the product range a name and defining it on your website is hugely powerful in communicating to brokers, that we're open for that sort of business. And so I think complex income would absolutely, the gig economy of which you've just spoken, will be really important moving forwards.
Yeah, I think first time buyer is a really kind of area that needs to continue the support. Again, when you've got the Help to Buy 1 scheme come to an end, you're going to have things like the impact of the regional house price caps from Help to Buy 1 for first time buyers. And being based in the northeast, we've got the lowest kind of house price cap. But again, when you look around kind of the new build estates, even in the northeast, for the house price cap that's being applied, they are going to be very limited in terms of choice of property. So it'd be really interesting to see them dynamics play through, especially in a market where, high LTV lending is restricted. So I do think there's going to need to be some continuous innovation in that space to help continue supporting first time buyers. I think as well, from my perspective, it's important to not forget the second time home movers are really important in this as well. And they're going to lose access to the Help to Buy scheme. And again, something like that, whether you agree with whether the scheme was intended to kind of meet the needs of those people or not, you can't get away from the fact that people were in kind of properties as first time buyers and have used the Help to Buy scheme to trade up and move on. And then that level of kind of transaction movement in the market has been good. And taking that away, it will be interesting to see what the unintended consequences of that next year. And I think, we're going to need some product innovation around that to keep supporting that and helping people move through.
Yeah. Anything to add, Tracy?
Well, I mean, from what we've seen, we've continued to support shared ownership and affordable housing, and that has been really, really active, especially with withdrawal of the higher LTV mortgages. So we'll be looking to support those, and we'll obviously, I know there are quite a lot of innovative products coming out from private companies sort of looking at shared ownership or looking at that type of scheme. So we'll be exploring some of those as well. And like both Darren and Carolyn have said, first time buyers are in our DNA. We want to support them. That's what we're here to do, help people have homes. So yeah, we'll definitely be continuing supporting first time buyers in the future.
I think green finance is going to be a topic for next year. I can feel that momentum is being obtained. I think obviously the BSA has its task force looking at that, and I think that plays in well to the self and custom build market, and the announcement of the launch of the government's Help to Build package, which they're bringing out, which will spotlight that market and will encourage people to build more energy efficient homes or renovate their homes to become more energy efficient. So I think we should see a lot more emphasis on that moving forward, and certainly we're looking to have a product out on that to play our part, to join the ranks of those lenders who have already done so.
I think the other part is obviously buy to let. I mean, people need to find homes, and whether or not they can afford their own. I think, landlords and having housing available for tenants is really important. So, and expats and Brexit and all of the other bits and pieces, I think there's going to be an awful lot going on next year. So we've just, I think as small lenders, we are quite flexible and we can actually move quite quickly. So yeah, I think product innovation is going to be quite exciting next year and important.
Yeah, I think that's a great point, Tracy. I think that's the great thing about the lenders on this particular call today is kind of our flexible approach to looking at people's individual needs and circumstances and taking them into consideration for mortgages. Now more than ever, people are going to need that through next year and beyond. And I think our support to the market has been strong through this period of time, and I'm convinced it'll be strong in the years ahead.
Just picking up on Carolyn's point around sort of the green and sustainability aspect, and it kind of goes back to one of the earlier comments around surprises in the survey, or the outputs from the survey, was just the number of lenders still producing huge piles of paper on a daily basis. I really was astounded, and the whole smoke and mirrors of print and rekey, etc. Do you think we will finally now move away from paper, and get to a completely paperless process, i.e. no printing of offers, no putting offers in the post, removal of wet signatures, all that kind of stuff? Do you think now's the time to move forward with all that?
I think definitely. I think it was one surprise from my own lender report was the fact that we scored so highly on completions compared to a lot of people. And I think it was because the previous year or so, we've been taking paper out of our processes. And the completion process, once upon a time, was, printing off loads, carrying it around the building, getting people to sign it, check it, etc. And we stripped all of that out.
Good.
And so when we moved into remote working, it was so easy. We didn't have that headache to contend with. We had a few others, but not that particular one. So I think we were riding a wave of feeling great. But that said, we rapidly then looked at all of our other processes, which required a signature, a wet signature, paper, and we've been slowly stripping it out. So digital e-sign, all different sort of processes that we can introduce. So we've been doing that over the last sort of 6 to 8 months. So yes, I can't see us going backwards. All I can see us walking, moving forward in that.
That's good.
And we would have been an offender, Steve, of the paper variety prior to this. And there's nothing like a pandemic to cure you of that terrible habit. Absolutely, we've out of necessity. So we didn't have the lead-in time that Tracy had, but out of necessity, we got there relatively quickly and relatively painlessly. Actually, it's amazing what you do when you absolutely have to, isn't it? I wouldn't want to work under that intensity all the time, but no, I think we've shown how well we can adapt as a sector and how well we can pull together and support a market, and so there are some positives that we can take from that.
That's a really good point, Carolyn. There was I read a quote or a piece the other day. I think it was McKinsey's have surveyed a number of industries over the last 6 months, and they claim, or the report claims, that they've seen almost a decade of technology change squeezed into 6 months. I mean, that's astonishing. So to your point, Carolyn, it just shows what the art of the possible is when individuals, when businesses find themselves in a position of having to do something. So hopefully, we can. I get your point. We don't want to be under that level of intensity all the time, but I think hopefully it gives people the impetus to push change forward, for the future.
I think on the green mortgage, from a green mortgage perspective and a green kind of cultural perspective, I think there's still a lot of work to be done in terms of understanding and kind of how that's relevant to each individual business or mortgages. Because again, I think it's, you know, something that I think people are taking really seriously within their businesses, but I think they're at a very early stage of kind of maturity in terms of formalising their thinking and plans, not just in the kind of mortgage process, but actually what is their carbon footprint strategy moving forward as a business, wider than just mortgages. But also, how do we encourage homeowners to kind of go through that ethos of making sure that they've got the most energy efficient homes, and how do we kind of make it relevant and kind of engaging for them to get involved in that as well? Because I think, you know, most people, when you talk to them, will say, yes, I really want an energy efficient home. And then you say to them, well, what's the next steps you're going to go through to make it happen? I think that's where the kind of understanding, certainly within the industry and with the consumer, kind of starts to fall down a bit. And I think until we can get really good specific plans around how and what things can be done, we're still going to be in a bit of a stalemate on that front.
Yeah,
I think we're on a massive educational sort of drive at the moment, not only for us, but our customers as well. So I think there's got to be, you know, a lot more out there sort of insight really to help people understand what it means. I mean, I read something recently that if you're building a new home, having a heat air source pump costs £5,000. If you want to retrofit that, you're talking 23, 24. You know, it's sort of having that level of understanding, that basic level of understanding. What does it mean for me? And to make those choices again, depending on what your sort of resources are. So yeah, I think there's an awful lot more we need to learn as a sector.
I suppose it's the difference in some respects. In other areas of financial services, you see the ESG agenda being talked about and actually being trying to be dealt with. And it's about inculcating it into your business as opposed to being a cost of doing business, which is what in the past it's generally tended to be, isn't it? I mean, even carbon offsetting is that kind of, well, it's okay if I do this as long as I plant a tree, you know, and actually it's not that, it's putting it into, as you say, your lending criteria, maybe your pricing or whatever it is, if that house is of a particular type or you're encouraging that kind of thing. So I think the Chancellor last week did a speech, didn't he, where he said, you know, over the coming years, one of the 4 pillars of financial services in the UK is going to be that environmental one. I think technology was the other, and equivalence and regulation. So there's clearly a big drive for this, and as you say, Tracy, it's, you know, got to learn what it actually means for us all, I suppose.
I think getting back to Darren's point as well, you know, how it impacts consumers and how do you actually motivate them? I'm looking to sell my property at the moment, but I've still got an old EPC from, you know, who knows when it was actually completed, but we've done stuff to kind of insulate the house since then, but there's been no push on the part of estate agents. Oh, have you thought about having a new EPC? What's the benefit to us, etc. Going back to Tracy's point, you know, actually trying to understand, make it real for people, and actually then change, I guess, people like me in terms of selling a property or buying a property, the decisions we might make. It seems we're a long way off from that at the moment.
Yeah, and I think what we want to be able to do, we need to tread the right balance, because we want inclusion as well. So, you know, by promoting green mortgages, what we don't want to do is have an unintended consequence where we exclude people from finance and kind of mortgage availability. You know, because there will be some people who you know, naturally are not in a position to afford to be able to make the improvements to the property to meet EPC ratings and things, and therefore, you know, what we don't want to be in a position to do is kind of saying to those people, you're not eligible for a mortgage either. Otherwise, it's going to leave huge sections of the population that won't be able to be served for a mortgage. So we have to kind of get that right balance between kind of encouragement and doing the right thing, and not kind of excluding anybody from it.
Yeah, it's definitely carrot, not stick on this one, isn't it? Really, it's encouragement all the way.
Well, and I suppose that's the joy of that term ESG, is that it's environment society. So you don't get to actually do one and not the other. So good luck with that. We're sadly come to the end of our time. So I'd like to thank our guests, Tracy, Carolyn, Darren, Rob and Steve, for their time and contributions today. I hope you've enjoyed this edition of Future Mortgage Efficiency Broadcast, and we look forward to doing our next edition, where we'll be talking to some of the specialist lenders about the challenges and expectations of lending for next year. So thank you very much again.
Thank you.
Thank you.
Cheers.